Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio since 1977. In the past 30 years, I saw many business cycles, financial cycles, bubbles, recessions, great recessions. These are some of the impressions I got. These are some thoughts that I thought it might help you in managing your money. One of the first things that I learned in investing is that long-term investing does not exist. That's an easy cop-out for those who do not want to manage their portfolio. Just buy anything for the long run. But the long run does not exist. Example, look what happened from 1966, 69 to 1982. Look what happened to the market since 1999 to 2012. The markets are basically flat. The only time they rose is from 1982 to 1998, so only 17 years. So most of the times the markets actually trade in a range. That means that you need to manage actively and understand what's going on and be careful on how you invest your money and which asset classes you choose. The only way you can adjust to the investment climate is to understand the business climate, and the only way to do it is to look at what happens to the business cycle. I have many other videos on the subject, and both on my website and on YouTube. It's very important to understand if the growth of the economy is above the potential or the growth of the economy is below potential. The asset classes and the investments that you make in phases 2 and 3 are totally different from the investments that you make in 4 and 1. Again, this is not the presentation to discuss this, but you may want to refer to other presentations I have, videos I made for YouTube or on my website. Why the business cycle matters? Because the business cycle is driven by business decision, and the growth of the economy drives profits, drives interest rates, drives stocks, drives commodities, among other things, gold and oil, and drives currencies. So the business cycle is what really is the input to your investment process. If you want to be a successful investor, you have to have an investment process. You have to stick with it. You can change it, modify it a little bit, but have a basic investment process that fits your personality. What is my investment process, and the one I recommend to people who ask me? Well, I first start with an outlook for the economy. Is the economy strong, or the economy is weak and there is slow growth? Why do I care? Because of the kind of growth that we can expect has an impact on interest rates and in other asset classes. You decide based on that which investments. Of course, the investments that you make for a slow growth economy are totally different from those in a strong growth economy. Then you measure your performance of your portfolio, not more than 10-15 positions. If your portfolio doesn't outperform the market, there is something wrong with it. So slowly look at it. Why does it underperform? Then look at those positions that really are hurting. Well, have the guts of reducing, slowly moving away from the positions, investments that are hindering your performance, and move the money to those investments that are outperforming the market. So rebalance your portfolio very regularly. Every day check the performance every week, but you have to rebalance the portfolio or look at it very seriously at least once a month. One of the things that I was really impressed with is that momentum works. Why? Because momentum in the price of investments lasts a fairly long amount of time, because momentum reflects changes in the economy, in the management of that company, and in the marketplace. This change lasts for a long time. But again, you have to watch it very carefully because you can have a loss of momentum eventually. But again, this depends on how the economy is performing. An important concept I learned is that we cannot trust the experts. Just think about all the PhDs, Nobel Prizes, and experts in Washington. Yet this century has been plastered with depressions, like in the 1930s, recession and inflationary periods like in 1970s, wars from 1910 to 2010, and bubbles of all types. Look at the 2000 technology bubble, the credit bubble, the subprime bubble, the European bubbles. Can we trust all these experts? Absolutely not. What is the lesson you have to learn? You got to learn to survive. Can we learn from history? The short answer is no. Why? Because history is random. This is the basic reason we seem to repeat the same mistakes. And this has also an important impact on our investment approach. Why is history is random, and why people don't seem to quote-unquote learn from history? Because the name of the game is power and wealth, and these are the ultimate objectives of the game. So at any point in time, the people will play the game to acquire more power and wealth no matter what. What is the answer then? Well, there is nothing more valuable than formal educations. Where you don't know what to do, study and learn. And probably this is the reason you're going through YouTube, trying to find out and learn to survive the investment game. Thank you again for reviewing this little video. I hope you got some ideas. Hopefully you will benefit. That was my only purpose. And if you want to find more information about my work, you're welcome to visit www.peterdag.com.